Let's look at Canada. First off, read this disclaimer carefully. We will also, of course, get to know the big picture of the markets. So let's just quickly look at what happened. This week was pretty crazy. We did see a major pullback in the stock markets, which, it didn't have a clear trigger. That's the spooky thing. Hence, yes, this market is still pretty darn crazy. Here you can see some of the moves from the 52-week low and 52-week highs across major asset classes. Here you can see some breakdown of the sectors. You can see that energy, basic materials have the biggest moves from the low. Closest to the 52-week high is tech and communication services. Here you can see the zeitgeists, and these on the average they are massively outperforming the S&P 500. So there are some extremely powerful trends here for sure. King of the hill from the 52-week low. It seems like it actually is education 2.0. Pandemics also a big mover. Yeah, some very strong trends. Okay. So today we will look at a North American country, Canada. Here is some information about the Canada EWC ETF from iShares. Here is the GDP of Canada, the Consumer Price Index change, almost identical with USA. The total tax rate is much lower in Canada. That's interesting. Forested area, 38%. Okay, so let's first get the picture of the seasonality of this ETF, the EWC. So here is leading up to the top of the housing bubble. Also includes the .com bubble. Okay, we are currently in June, and you can see that June and July are historically weak months they are the weakest months for the ETF. Okay, let's zoom and look at the most recent period between 2009 and today. So these are the percentage of months in which the ETF closed higher than it opened. You can see here that June 50%, but July has now become actually a strong month. So there's been a clear change in the seasonality here. But it is 64%. However, the problem is that August is very weak. So a very adjacent month is literally the weakest. So that's a bit of an issue. It means that we have to take this with a grain of salt, given that the following month is really problematic. You can see here that May is also weak, so this entire period here is dicey. Let's first now look at the charts, weekly data points, and we go all the way back here to, Yes, let's go all the way back here. So here we have, the double top before the housing bubble imploded. And then, quite interestingly, you did see a bull market, but the bull market was very fast and furious. So 150%, topping out here in 2011, but that's when the Canadian bull market ended. So if we do measure from this high to the recent low, minus 49%, and even if we measure to the current level, that's minus 22%. So you could make a case we have lower highs, and we also have lower lows, meaning you could make a relatively strong case that Canada, it's been in a very long bear market, multi-year bear market. That's interesting. Okay, 9 years in a bear market, and we can see that there are some clear cyclicality here. So, since this collapse, we do have a rising cycle, but as is the case with many markets, is that we've had a very fast and furious rising cycle. And when you have a very sharp decline and sharp rise, it does disrupt the cycle patterns. We did test the 5-week moving average. This week we found support that is good. Hence the bulls, even though they have a bit of a dicey situation at this point, they can stage some kind of recovery if we do get more rally next week and the coming weeks. but there are some very serious resistance levels here in the form of the moving averages, and you can see that this entire zone, this battle zone right here, this is where there's been failed battles before, and you have to ask yourself the question, is the Canadian economy is stronger here than it was here, here, or here? I doubt. Hence, there's a risk. The accumulation distribution line, it has been rising relatively consistently. And as we will see when we look at the fundamentals, there is more value in the Canadian stock market. Correlation with S&P 500 is 42%. That's nice to see if you are looking for some statistical diversification. Here are the daily moving averages. Daily. Yeah, this is a bit of a problematic. Okay, this is not good. So we go up here, surgically test the red 200 day moving average, and we were rejected. And we closed below here many key moving averages. We did find some tepid support at the 100 day on Friday, but this is rather vulnerable. This is quite vulnerable actually. So we were overbought, so we were kind of begging for trouble. But yeah, this is a bit dicey. And the biggest issue here is the long-term picture. Long-term, we have been in a bear market for 9 years. Though, there is more value. And if we do see some flight to value, that could be, at least it could minimize the pullback in Canadian stocks. But let's look at that now. Okay, here we can see some other data. So the dividend is 3%. Well, 2.7, that's decent. Here is some performance data. Year to date, minus 14%. Okay, so the expense ratio is 0.49%. Not the cheapest, but okay. Okay, I guess. Let's look at the dividend valuation. Here's the PE ratio is at 12. Okay, so let's compare it with the SPY. So the SPY is at 17, so the SPY is definitively less value. Let's look at there is no ESG, environmental, social, governance, 6 score ESG here. Let's look at the same thing for America. Yeah, America has a better rating, but this is explained if you look at the holdings. Here are some of the top holdings. Royal Bank of Canada, Shopify, fantastic company. Here is the breakdown, and you can see that financials is actually pretty large, 36%. Then you got tech, consumer non-cyclicals. Energy is only 11%. I expected energy to be a bit higher, but it actually isn't. If you look at the holdings here for the S&P 500, if you look at energy, it says it's at 3% here. So energy is definitively a more significant part here in the Canadian stock market. There is market cap breakdown. You can see that large cap, pretty darn huge. Regional breakdown, market higher. Yeah, pretty interesting site, ETF.com. Okay. So to sum up my hot take on the Canadian stock market, we have been in a very long bear market, 9 years, which suggests very strongly that the health of the world economy is worse than people think. Because many people, they do this. They look at the S&P 500 and they are like, wow, the world economy is doing fantastic, making new all-time highs. But then you look at EWC. Oh, this looks a bit sick. If you look at the Japanese stock market, well, weaker at least than the S&P 500. If you look at United Kingdom, the previous superpower, this is a very sick stock market. If you look at some other, world economies, let's look at Germany, pretty strong, but significantly weaker than the S&P 500. Let's take a trip to Russia. RSX, weak. Let's take a trip to And maybe we should have a bit of a look at, yeah, we looked at Australia before, but you see Australia also, there is a lot more weakness than people think. Okay, so let's look at some other markets. Let's look at the NDX. This is the bond market. We are using weekly data points in this video just to sort of get the bigger picture. So you can see here that throughout these years we have seen a steady rise. During the weakness we had in the stock market this week, we did see some money flow into the bond market. So that's interesting to see. Let's also look at the TLT. The TLT, a strong week here for TLT. But we are below this declining 5-week moving average, which means that the rallies are, guilty until proven innocent. Then we'll look a bit at gold. Yeah, we did see some panic in the market this week, and gold had a strong move, which makes a lot of sense. There is some clear cycle patterns here for gold. You see this rising and declining cycles. Let's see if we can actually get some clear cycles here. Not necessarily, but let's do it like this. Move the cycles around a bit. Yeah, we do get at least the more recent cycles. Recent rise, decline, rise, decline. But the most recent cycle is actually a bit thinner. Judging by the previous rising cycles, it certainly seems like we are seeing something that's happened many times before. Rise, shuffle sideways, and then potentially a decline. We are shuffling a bit sideways now. I would not be surprised to see that we maybe correct a bit. But all in all, it's pretty clear that, if you look at the very long-term picture here for gold, this is a rounding bottom. This is a very strong technical bullish pattern. But in order to break out above these levels and make new all-time highs, I think it would be prudent to maybe form a cup and handle pattern. So this would be, it would be this cup, and then if we move like this, and then we could make that push and smash these levels. Because you need to sort of have enough energy to do that. If we from these levels just try to push above, it would be very dicey because there's a risk of a failure. Let's look at agriculture, the DBA. We are still seeing this rounding-ish bottom pattern here. It is small, tiny compared to what we saw with gold, but there is something happening here that could potentially be bullish. So we will keep our eye on agriculture. Let's look at COPX. Oops, yeah, the COPX, like this. Okay, so these are the copper miners. You could make a case that we have a double bottom, boom boom. It's been in a major decline, hence there's certainly better value here than it was up here. Strong rally of the lows. Let's actually measure this move. It's been 67% up to the high. But arguably it was a little bit too much too fast, and we have seen these cycles before. Yeah, very interesting pattern though. You do have this double bottom function, but you do have some very clear cyclicality. It moves in these waves, very obvious waves. Up, down, up, down, up, down. Now there's been a strong up move. Historically, the moves are usually followed by some pullback. Let's look at UUP, the dollar index fund. After we have had this major super spike in the dollar, there's been some surprising weakness. I did expect a pullback, but not of this magnitude. We have, however, we are finding support at the blue 100-week moving average. It has been a key level in the past, as you can see here. Boom, surgical test. Here it is a solid resistance level. So this is a moving average with history. So that's a moving average to definitively watch going forward for any kind of bounce in the dollar. Let's look at the WIX, the Cboe Volatility Index. So if you look at the bigger picture here, if we go way back, here you also get to know the housing bubble. we are still at some elevated levels. We are, way above these levels here where you had a very clear bull market. And this shows you that even though the market has been going up strongly, there is still a lot of skepticism. People are not even remotely as complacent as they were back here. And the move we had this week here on the Wix is very sharp, very, very sharp indeed. Which goes to show you that Wix is it's a pretty good way to hedge a portfolio. If you are primarily have a bullish leaning portfolio, hedging it with some positions on the Wix could be quite prudent. Let's look at some stocks. Let's look at Amazon as an example. The king of e-commerce. This is definitively like a best of breed example. You could make a very strong case that we are overextended. Looking historically at this stock, it usually does have some pullbacks. And the RSI is like, it's very stretched. Previously, when it's been this stretch, we have seen some meaningful pullbacks. This pullback here, as an example, it was 8%. And there's been bigger ones. We do see this reversal pattern here. We go up and then we close significantly lower. So this is certainly an initial sign of fatigue, meaning there could be some short selling opportunities with Amazon. Let's look at an Netflix. Here, this stock, you see that it moves in these major cycles. Let's do some cycle pattern analysis if we can see some clear cyclicality maybe. Let's see. Like that. You can see rise, decline, rise, decline, rise. Well, we haven't seen much of a declining cycle on this pattern yet. Hence, we are very much due a pullback, given that historically it's happened more frequently. And these cycles here and here, this happened, before the whole pandemic situation. And even though, of course, people are watching more Netflix than they used to, it still is the case that these money flow rhythms, they do have a tendency to come back. So this is also could be a short selling opportunity. Let's just go through some of the Fangman. So here I have Microsoft. We see something similar to what we saw on Amazon, is that we were way up higher in the week and then we closed significantly lower. So you have this inverted cross, sign here. So also so maybe due for some pullback. You also have a bearish divergence here on the RSI, much higher here than here. This is something we also see actually on the Nasdaq. So here we have, so even though price action is higher here than here, we do see a significantly weaker RSI, which is a bearish divergence. Let's look at some other companies. Let's look at Exxonmobil, one of the big boys in the energy business. Solid pullback, finding support at the 20-week moving average. There could be some very strong trading opportunities in the energy, the fossil fuel business names, but long term I am very bearish. I think that I see like there's so much pressure against them. Okay, this was some stocks, getting some picture of what's coming for the week going forward. Well, let's actually quickly look at the WT, which is the total world stock market ETF, and look at some seasonality here. Let's do it like this. You can see that. Let's go even further back, like that. You can see that the June, and we are in June, it is the weakest month for global stocks. That's something to take into account. And that corroborates the idea that there could be some short selling opportunities. Whatever you do, of course, you want to let the trend be your friend. And given that we saw a huge pullback in stocks this week, which was completely unexpected, not on any kind of big critical news, it shows you that this market is crazy. This is a crazy market, and in a crazy market you want to be hedged.